Welcome back. This is Chart Overload. I'm Ryan Mumy, CEO of Sollinda Capital Management. With me is Justin Greenhill, our Chief Investment Officer. On Chart Overload, we just try to go through some of the interesting things that are percolating out there on the chart front. I say it's Chart Overload. Justin says it's not, but we'll let you be the judge. Starting with the big picture, Justin, this first chart looks at fiscal deficits going back to 2022, and this year's on pace to exceed the last several years.
The old deficit. Looking at this chart, you see a common trend up and to the right with the temporary dip around tax time. So the government gets the money, the deficit
Waiting on
drops,
payday.
and then we're off to the races. So I think the notable thing here is, with the exception of 2023, thus far, this year is even big by relative big standards in terms of what the deficit is. So this is something we continue to kind of point out as it has impacts across society.
Yeah, waiting on payday and then ramping it up. But this hasn't mattered, right? This hasn't mattered, even though really the last 60 years people have been talking about fiscal deficits, and it just hasn't mattered yet. But I mean, one day it will. The US has grown itself out of this for the time being. Next chart takes a look at money market holdings. And for you and I, that's always a counter to any bear narratives that are floating around is, yes, but I mean, that may be true, whatever it is that folks are saying. Yes, but do you know how much cash is sitting looking for a place to go? And this highlights it exceptionally well.
Yeah, this is the proverbial cash on the sidelines that you hear about so often, and it's a big, big, big number. So I think we would think this kind of connects to the deficit in that there's just more money in the economy, and that finds itself into different ways. But whether or not this money is at play to go into stocks or bonds or whatever, one would have to assume that a good portion of it is in play. So, which this could be the next leg of the bull market, right? In terms of just this money getting more comfortable, finding its way into more risky assets.
Or staying in money markets and people taking out some sort of lines of credit based on it to do just that, right? Because leverage, synthetic, creating purchasing power is a big deal, and it's used often, especially by institutional investors. Next chart looks at the price of computer software and accessories, and as we see here again, up and to the right, that means it's getting more expensive.
Yeah, this chart's really interesting. The big talk of late about inflation has naturally been kind of the pass through from what was a pretty sharp spike in oil prices. But what's perhaps kind of less talked about is what's already coming in and what will continue to come in over the next year based on projections, which is just anything to do with electronics is basically going to get much more expensive as a result of there being a major shortage in terms of memory chips, et cetera, all kind of coming back to what we've discussed and shown graphics on, a massive AI CapEx that's ongoing.
You and me talked about this. I just mentioned it in passing, but I bought a new computer at the office and our chief operating officer wanted a new one. So I went to look for the exact same computer and the price had went up 60% in 5 months. And that just, again, anecdotal evidence of this chart that there are many pass-through costs happening for various different reasons that extend beyond oil. Next chart looks at some specific products relating to computing power. And again, the inflationary prices are going up.
Yeah, so big thing to note here is the gray shaded area, which is, at current just a projection, but based on all the known information. And looking into next year, the cost of new vehicles and the cost of just computers in general, to your point, are expected to go up a significant amount, which will pass through to the consumer, and we'll see how the consumer responds. They may have to, referencing the prior chart, spend some of that cash on the sidelines to purchase a new car.
Which, yeah, that's flow through to earnings maybe. Last chart in the big picture takes a look at the City Economic Surprise Index relative to the Economic Price Pressure Index. And obviously, they're often correlated, and there's a bit of a gap here.
Yeah, this chart really has kind of highlighted what we've been talking about for some time, in that ultimately the market has kind of just looked through what has been this recent surge in price pressure. So the black line here also incorporates the rate of change in interest rates. It incorporates the rate of change in the US dollar, which affects multinational earnings, et cetera. And the takeaway is there's a huge divergence, meaning that thus far earnings have been good despite the fact that a lot of these inputs have been negative. And I think if we had to give it a narrative, we would tie that back to AI CapEx.
Yeah, it's pushing the economy and the market right through possible headwinds, which again historically have been headwinds that, you know, the argument is this time different because of insert whatever that is. This isn't the first time you or I have heard that in our careers. Eventually these will come back together, but that doesn't mean the city economic surprise index is going to plummet. It could mean the other one, the economic policy pressure comes up because it truly was passed through. I mean, the market looked through it properly. So again, to be determined. It's back to you can't take one chart and, trade it, if you will. It's more nuanced than that. Moving on to the domestic stock, the drum roll, please. The hot news, the ticker tape has been SpaceX. This is a great visual, just shows the sheer size of the IPO that launched last week.
Yeah.
Notice I said launched.
Oh, yeah. Yeah.
Thank you. I'm here all week.
That's good. You're a funny guy. Big by any comparison and any stretch of the imagination. And the prospectus for the IPO literally said that the total addressable market is space and time. So, I mean, you talk about just imagine possible revenue throughout all of space and time.
Home run hitter, Mr. Elon. It's a big deal. And something I've been pointed out to our advisor partners and our clients is you can't necessarily compare this IPO to last ones just because of the cycle of companies coming to IPO is much different than it was, say, when Google came out, right?
Yeah.
These are much more mature, further along companies when they IPO. But irrespective of that, it's a monster. And, we'll see short term performance has been very positive, right? Lots of that money sitting on the sidelines chasing those shares. Moving on, this is something we've been talking about for several months is looking at new equity supply. As we've described for many years, especially with large companies, it's been share buybacks, reducing the number of shares outstanding and companies not necessarily issuing new shares. And that's changing not just through equity issuance, but you have companies like Google, like Nvidia that are going to the credit markets and borrowing money. I think Nvidia just announced a $20 billion bond raise when the total amount of bonds they have outstanding up to this point was what, 6.5 or 8 billion anyway. It's a big number they're coming at. So again, there's all this new supply coming on, chasing some of that cash that's out there.
This chart's pretty stunning, right? When it just kind of makes you realize how not only have in some years there been negative supply in the stock market through buybacks and so on, but even the years that have seen increased equity supply, it was very small relative to what's coming down the line. So, on one side, you've got more money in the economy that's either directly or indirectly, we think, related to the deficit. But now, for the first time in many years, you've got perhaps equal, depending on how you measure it, supply now coming to meet that money. So the markets are currently caught up in a lot of momentum, but we think that as we get into the end of this year, into next year, this chart will become a bigger story in some way or the other.
Moving on, this shows why it's not an issue right now is earnings. Earnings have been very strong, and from a historical standpoint, they're trading right in line with their 5-year average, below their 3-year average, and above their 10-year average.
Yeah. So this speaks to earnings in that, you can't on an earnings basis say that the S&P 500, you could say that it's richly priced relative to a longer term history, but as you see here, just looking back over really it's kind of post-COVID time frame, it's not richly priced compared to a few other times. What is though different is that these earnings are no longer free cash flow, right? Because the earnings are then being recycled back into what is the massive AI CapEx. So the market's got additional equity supply and much lower free cash flow positive mega caps than it's had in recent years. Because before, the companies didn't need to reinvest in a lot of capex. It was all about the economy of scale of their platform businesses.
Or buying back
They're
shares.
buying back shares versus now they need data centers, they need chips, and as we've discussed, the capex is truly unprecedented.
Next chart looks at the S&P Industrials Index, and we see it took a little beating at the announcement of the Iran war, and we don't have a signed doc yet, but it's back to pre-Iran war levels.
And we put this up here because in a lot of ways, the big tech companies or the big tech light companies are very much, if not fully, a play on AI and AI capex versus industrials, which you see here is going to be a much more traditional cyclical. Are the global economic participants spending money, how that's passing through, et cetera. And the market would give that a green light go as well. So whether or not one disagrees with current market pricing, there is very much a impetus for markets to go higher, not just in the big tech mega caps, but seen here in industrials.
Next chart looks at levered ETFs, ETFs that give you double exposure, triple exposure, or more to whatever asset class. And the use of those has surged, right? I call it the trading on juice, right? You not only pick an asset you want to invest in, but you trade it with a little juice, and use of those types of product has skyrocketed here.
Yeah, there's a lot to unpack here. I believe it was on either this week or last week in our weekly commentary. We touched on the fact that this has really distorted some of the funding markets, right? Because the fact that these levered ETFs have to exist, there's margin that needs to be used on the back end, and there's a lot kind of in the underpinnings of the market that's changed as a result. But at minimum, what you see is most of this is retail. So people are not only in, as we used to joke and say, all in, they're all in on leverage.
The juice,
Yeah.
right? They're all in with some juice. I don't know that we're going to talk about it, but at the end of this week, there's a triple witching. There's a big reset in the options market and expiration. And, why that becomes an even bigger deal is because of that chart, right? Is how do those ETFs create the leverage or the double or triple intended movement of the underlying indexes through options? So it becomes an even bigger deal. Moving on to interest rates. First chart just takes a look at US Fed funds rate relative to the 30-year US Treasury. And as we see here, again, there's a bit of a dislocation, and we're heading into the Fed meeting tomorrow.
Yeah, so think of the red line as being this is the 2-year yield. So basically, this is the market's expectation for what the policy rate will be 2 years out. And as you can see here, at least in recent time frames, it doesn't spend a lot of time above the policy rate unless we are going into a rate hike cycle. So assuming that a rate hike cycle does not manifest here, then one could just by looking at this chart say that the 2-year yield, the yields are a little bit rich. And, if the Fed signals that they are not as going to be as quick to hike rates here as the market might think, then you're likely to see that red line come back down pretty sharply.
Yeah, because right now the market is pricing in rate hikes this year. And again, the 2-year is a reflection of the Fed funds rate and the expected funds rate. So again, depending on what happens with, we got to come up with a nickname for old Kevin Warsh. We've had a nickname for all the Fed governors, Uncle Jay, Aunt Janet. I mean, he can't be Uncle Kevin because he's too young. I don't know. We'll have to do a
Well,
big reveal.
Yeah, and I think that gets to a chart we're going to show here in a second. We really don't know what his identity to the marketplace and in the job is going to be.
Yeah.
He has somewhat of a hawkish or sort of like an austerity bend, back to when he worked for Stan Druckenmiller's hedge fund. There's that narrative, clean up the Fed's balance sheet and so on. But at the same time, he was Trump's guy or is Trump's guy, who is very much lower interest rates no matter what type participant. So tomorrow should be a very interesting meeting of what will be the first of probably many interesting meetings because to the point, if the Fed were to act on the information right now, they would be hiking rates. But at the same time, the market is in many ways looking through that inflationary impulse. So the Fed's going to have to make a call, right? Do they respond to the data or do they assume what was infamous word transitory.
Yes. And I had jumped the gun earlier. Here's the 30-year chart. And as we see here, we did not miss a chart overload without some of Justin's artwork. So thank you for that. But as we see here, it recently has come down from some highs around 5.2% yield. We've fallen right back down, but looking back further, we see it, it's touched that level 3 times and fell from there. So the question becomes, does it pressure that, or is this repeat the previous 2 cycles?
Yeah, I mean, you could pretty much pick your story and tell it with this chart. You could say that when in fact yields do sustainably break above those levels on the long end of just above 5%, there's going to be a kind of a major cascade of change throughout the market and throughout the economy. Or you could say that, we're at the end of a high rate phase here and that inflation will pass through, AI will create more productivity, and the world is under-owned in terms of long duration treasuries. So there's just a lot of uncertainty around both interest rates and policy around interest rates at the moment.
Yeah, and what the market and participants are ultimately pricing, it matters because while technology advancement is deflationary in its, I mean, by its nature, it creates efficiencies, the initial build out is inflationary. So again, what exactly is being priced in is to be determined, and that's why we pay such close attention to just not the short end and what the Fed's doing, but to the long end and what market participants are collectively pricing in. Next chart, this is the chart that Justin referenced. This is words produced relating to the Fed's current or future path. That's really, really ramped following the financial crisis.
Yeah, so this is a really key thing to take note of going into tomorrow's first Fed meeting with Warsh as the Fed chair is that if you look back in far history, there was really not a lot of commentary by central bankers around what they were going to do. They would just do it and then the market would react to it. And there was kind of a shock factor involved. I think you mentioned on our last video, Ryan, about how people used to try to analyze Greenspan's briefcase
Yeah,
or
at the end of meetings.
whatever it may be, post global financial crisis. And Janet Yellen and then Jerome Powell, there was a huge shift to not only the Fed giving what they call the dot plot in terms of like an outlook, but then there were these long press conferences of which, Powell would talk a lot about what he thought or didn't think, and the market would, respond oftentimes with a lot of volatility. There were more volatility on Fed days than there were non-Fed days for a number of years, and this explains it. So lots of talk around the outlook from the Fed. New chairman Warsh is now saying that he's going to do less of this. So
Yep.
he's looking to take this chart back towards what you saw on the left and a lot less of what you've seen in recent years there, the blue bars on the right. So again, we'll have to see how the market responds to that.
Yeah, again, that's why, I mean, all eyes, as Justin just mentioned, lots of volatility around Fed days because of the press conferences, the dot plot released a couple times a year. But this is new for Chairman Warsh, so we don't know. He's going to set kind of a standard here and set expectations for what to expect from this Warsh-led Federal Reserve moving forward. So we will see. Moving on to our next section. This is non-U.S., aka the tour. First chart looks at U.S. dollar. The demise of the dollar is, I guess, one of the longest my entire career. It comes in spurts. Well, factually, that hasn't been the case this year. And recently, investors have increased their bullish bet on the U.S. dollar.
Yeah, of all the asset classes out there, we would say that the foreign exchange market has the most simple narrative when in reality it's actually moved by the most quantifiable mechanics, right? You've got real economic participants globally in terms of what they're doing, and then you've got so called speculators. So, what this measures is if you look at CFTC futures and options data, which comes out weekly, and you separate, participants who are hedging something and you just isolate participants who are making a bet on direction, that's what this is. So speculative participants in the futures market during this event with Iran really went from betting on the dollar weakening in general to then kind of sharply reversing and betting on the dollar going higher. So the way we like to look at this is these participants are attempting to kind of go with the price or get ahead of price and follow a trend. But ultimately, they're not the big driver in the market. The big driver is economic participants that deal in the currency. So if the dollar does, in fact, kind of roll back over, generally speaking, not saying crash, but stop appreciating, then these positions could go away quite quickly. And that's just be another impetus on perhaps a weakening dollar at large into the end of the year.
which is
Again, the Fed, right? Back to
yeah,
the Fed.
which is also positive for foreign equity markets. Traditionally, it acts as a tailwind. If we remember pre-Iran, non-U.S. equities were leading domestic shares higher on the year, and that's stabilized through Iran. So we will see from here, to Justin's point, what happens. Next chart looks at Brazil. Their inflation, we've seen in the U.S., their inflation jumped more than expected last month, and they have a presidential election coming in October, and their central bank meets this week as well. So we'll see what they do.
Yep, the meeting is the same day as the Fed tomorrow. It happens after hours. So, likely what you'll see in the dollar Brazilian real exchange rate is there'll be a response to what the Fed does, a response to what the Central Bank of Brazil does, and then really the market will try to digest what the difference would actually mean there. But when looking at this chart, you'll see that inflation has started to pick up in Brazil, but their interest rates are much higher than inflation. And that's been the case. But from here, if the dollar were to continue to strengthen, that's an inflationary impulse into the country. So there's really going to be a lot to potentially transpire in terms of the Brazilian market now and into the election. Both idiosyncratic, what's happening in Brazil, but also the exogenous impact of how the market responds to the Fed and back to the prior chart, positioning in the dollar and so on. So lots to follow there if for those that are interested in that market.
Next chart looks at Chinese consumption, and as we see here, its retail sales have been falling and are forecasted to go even lower, which is kind of a new phenomenon in that U.S. companies were trying to get exposure to the Chinese consumer. Now, in many instances, they have it, but it's been weakening here over the last year.
Yeah, this has been a theme we've kind of been, I guess, following periodically for some time is the fact that not only has the Chinese consumer at large been weak, but it seems to just increasingly weaken, meaning that people are just not out spending money in China. And, there could be various reasons for that, but for whatever reason, they're saving because the country's making money through exports, but it's just not being spent domestically. So, people hypothesize a lot of it has to do with policy, trying to kind of clean up what was asset bubble there and inflation, because again, just keeping society relatively content with conditions is very important to the Chinese government. So for now, this hasn't really impacted global growth or anything of that nature, but it is an interesting anomaly, right? To see the world's biggest economy have such a weak consumer when we've got such a vibrant consumer here in the US. It's an imbalance.
Moving on to commodities, our last section. First chart looks at WTI oil. And as we'd anticipate with all the headlines from Iran, that is sank quite a bit here recently.
Still higher than it was, no doubt, but definitely way off the highs. So again, we'll see how the market digests this, but we're kind of at the phase now where, to your point, the market's looking to, as best it can, price in the fact that the Strait of Hormuz will be open. And assuming that stays true, now we'll get to kind of see, what does the actual physical market of oil think? Like, can oil go back to where it was before this, or is there going to be a premium to price based on the uncertainty of supply and so on. And that will obviously then tie back into inflation and tie back into the Fed. So we're at a time in markets where a lot of different things are now kind of converging on one thing, which is what will central banks do about price pressure?
Continuing on the oil theme, this looks at U.S. emergency oil reserves, and they're really low as the government has released lots of them to damper gas prices.
So if we remember, Biden released a lot of these, or the Biden administration during the initial Russia-Ukraine conflict of 2022. And then, criticized by Trump, they started to buy back some of these reserves. And then ultimately, when the Trump administration needed to, they emptied more reserves to combat the recent spike in oil. So, back to the prior comments, everything has been done from a policy standpoint to limit high oil prices. And for now, that looks to have worked. But assuming oil prices, for whatever reason, start to move higher again, there is exponentially less policy lever to get in front of that, as seen in this chart.
Moving on, our last two look at copper. This first one looks at copper's price relative to gold, and as we've highlighted, with the possible change because of copper's need in the AI capex, this relationship, as you see here, copper has dramatically outperformed gold, really since February of this year.
Yeah, real quick, but again, as you see in the chart, this comes after a long period of time of the price of copper underperforming the price of gold. So you could say that of late, the market is very much more focused on rotating from gold as an alternative store of value to copper, based on the fact that copper is believed to be in a pretty significant structural deficit based on increased demand for data centers, missiles, electric vehicles, and so on.
The last chart looks at the copper miner ETF. As you see here, it has stagnated relative to the price of copper to gold.
Yep, and maybe that has to do with the fact that it had a pretty huge run higher towards the end of last year into the beginning of this year, and at least as of today, it kind of looks to be consolidating sideways and perhaps looking to make its next move. So it's really
Which
all
could
about.
could be violently in either direction, right?
Yeah, I mean, just from a pure price signal at present, looking at this chart, one would have to assume that the primary trend is upward and this is a consolidation. But at the same time, a lot of that, again, might come back to, what is the outlook for interest rates? If central banks, led by the Fed, all of a sudden surprise the market with how vigilant they want to be on inflation, that'll likely be seen as a headwind to global economic activity, which will likely hurt the price of copper, at least near term. So we shall see.
As we shall see with all of them. But that's our chart overload. We appreciate you tuning in and spending some time with us. We hope you found at least something interesting, at least Justin's artwork, if anything at all. But we'll be back in a couple weeks to take you through some more collection of charts. If you want to reach out to us about anything, have any questions, reach out at info@sollinda.com, info@solinda.com. We appreciate you tuning in. We'll see you in a couple weeks.